Joining us now for instant reaction to that and the broader question of what's happening in the U.S. with the jobs report we saw today is Eric Pellicciaro. He's head of BlackRock's global rates investments team for the fixed income group. He joins us from BlackRock's New York offices. Eric, welcome to InBusiness. Important day in the markets for so many reasons, but can you give me your quick reaction to these headlines? Are we looking at the question of Greece's bailout now going back to the drawing board if we see IMF opposition?
A little bit. I mean, what we're focused on is the volatility that's going to be coming this month, not just in the Greece solution, but what's happening to Italian spreads as you're seeing it here. There's not a good picture of solidarity. We're not getting the confidence that we need. The bigger parties aren't agreeing. It's going to continue to weigh on the market in the coming weeks. I haven't seen the exact headlines, but I would imagine this means that there's a bit of a back to the drawing board feeling, and the market's not going to appreciate the volatility of it.
And before this headline, we had already seen in the swaps market the level of stress and concern skyrocketing, insuring against a default at record high levels there. Where are you most focused? Is it Italy? Is it Greece?
We're focused mostly on Italy. The contagion to Italy for us would be one of the worst aspects of this. So the problem is that the central bank there has pushed spreads and yields to levels that most private investors aren't interested in seeing. From our perspective and what we see from our own accounts, Italy has risk of being removed from many of the indices that we're benchmarked against. So as the ECB stops buying, or as it tries to transition off to private sector buying, we don't see how that transition is going to happen easily from here.
Well, we're also waiting September 7th, September 8th. This is just next week. Votes in Germany, a discussion about the size of the bailout, the EFSF fund, whether or not that gets expanded to reflect the expansion of contagion here. What are you expecting? Are we going to get a disappointment, or are we going to get what Europe says it needs?
No, I think we're going to get through that phase reasonably well, and I think the harder phase is going to come where how it affects Greece through the private sector involvement. I'm not sure we're going to get to that 90% target. There's a lot of risk that the buyers aren't going to be able to swap their bonds out to the 30-year bond issue that they want. And with that, there's going to be confusion. There's going to have to be more buying from governments and central banks, and that's exactly not what they want to see. So we think the transition is going to be rough. Going past that, it's basically centered around this sector involvement and see how it goes.
Eric, let's talk about what's happening in the United States right now. In the wake of that jobs number, people are really putting their chips on what the Fed can do September 21st to stabilize the markets and stabilize the economy. What do you expect Bernanke to do?
Okay, well, we think the jobs report today corroborates some of the weaker data we've seen. We have a central bank that's in easing mode. We think it's going to view this report as that it has to take action in the next meeting. Action for us means that the balance sheet is not going to grow. It means that there won't be necessarily QE3, if you will, but rather what we'll do is we'll get a change within the structure of the balance sheet. So the big question is whether they move out maturities of their paydowns that they're already reinvesting, or do they actually actively sell down some of the shorter securities for longer securities? The Fed is sitting on about $250 billion worth of short maturities that expire between, mature almost up to mid-2013. They can easily take those and move those out. That would have a very big impact on the Treasury market.